Our next paper is Regulatory Risk Perception and Small Business Lending. And Siddharth Vish from the University of Georgia is going to present.
All right. Thank you to the organizers for putting our paper on this great program. We're honored to present it here. So this paper is Regulatory Risk Perception and Small Business Lending. It is a joint work with Joseph Kalmanowitz at the University of Rochester, and I'm from the back-to-back national champion University of Georgia. So I had to get that in. Governments provide lending support to small businesses worldwide. And this support comes in many forms. In some countries, it's direct lending to small businesses by governments. In other countries, there are credit guarantees provided, though the loans stay in the private sector. And there's sort of a large literature on the outcomes of these programs, whether they matter for growth and employment, things like that. But this sort of literature sort of assumes away the role of the bureaucrats that are responsible for allocating this capital, right? The public employees that administer these programs. And so you could have one view that there's an impersonal, rule-based bureaucracy that implements the laws as written, runs these programs as they're meant to be run, etc. But another way of looking at it is, well, the regulators, the people who run these programs are economic agents themselves, and they have some incentives of their own. They also have certain biases, experiences, etc., that they carry into their jobs. Right? And so in this paper, we're going to focus on the Small Business Administration, which runs a flagship credit guarantee program in the US for small businesses. Recently, it was also involved in the administration of the Payroll Protection Program, the PPP. And we're going to focus on how the experiences of the employees of the Small Business Administration affect the allocation of capital through the SBA programs. Okay. So let me just summarize the paper very quickly. So the SBA is exposed to default risk because it must purchase the defaulted loans from the private lenders up to the amount of the guarantee. And we're going to focus on this idea of risk salience, the idea that how prominent is default risk in the eyes of SBA employees, not in the eyes of the lender, but in the eyes of the employees of the SBA. And we're going to predict that risk salience is going to reduce lending by the SBA. Okay? And mechanism is that it's going to increase the perception of risk, etc. I'll define all of these terms as we go along. And we're going to predict that SBA guarantees are going to be reallocated to businesses with lower perceived risk. Okay? To do this, we're going to utilize a novel employee-level data set. So we're going to have data on the entire SBA workforce. And we're going to use the locations of those employees to sort of build a bottom-up measure of their personal experiences. So what we find is that risk salience reduces lending and job creation. Right? So if employees perceive a lot more risk, there is lower origination of loans. And we're going to do this at a sort of an office industry level. And this leads to a decline in jobs and small firm creation because the SBA program is meant to promote job and small firm creation. We're going to have several empirical strategies. I'll talk about them as we go along. And then I'll also talk a little bit about how sort of the risk salience of SBA employees translates into lower originations, right? How they influence the participation of banks in the program, how they influence borrower participation in SBA programs, etc. All right, so let me start with a bit of background on the SBA. As most people in this room are sort of aware of what the SBA does. But one of its main activity is to provide access to finance. And so there are several programs that it runs, 7A, 504, etc. We're going to focus on the 7A loan guarantee program. Right, this is the flagship loan guarantee program of the SBA. And importantly, it targets businesses who cannot obtain credit elsewhere. So it is meant for, in a sense, the riskiest businesses, right? The businesses that cannot get funding on their own, so they need some sort of guarantee, some sort of subsidy to get that. But the loans, let me go back. The loans are made and administered by private banks. Okay, so the banks make the loans, they do all the paperwork, etc. They administer the loans. The SBA guarantees up to 90% of each loan, and if the loan defaults, the SBA purchases it up to the guarantee rate, right? So, so the SBA is run through local offices. There are about 80 of them. As this map sort of shows, they're spread all over the country. Right, and this local office, it's sort of going to be important in our study. What does the local office do? Well, it recruits and supervises banks. It has sort of a lender participation function, right? Sort of gets banks on board with the SBA's programs, etc. It also tries to stimulate demand. It reaches out to local business owners, tells them that, well, you can get an SBA loan if you can't get any other kind of loan, etc. So maybe you should approach your bank, etc. So it runs programs to do all of that. It used to have, the local office also used to do a screening of guarantee applications. That's a legacy function now. All of that is centralized since about 2007. Okay. Okay. Oops. All right. So our sort of idea, sort of hypothesis in this paper is going to be, well, is this idea of risk salience, that people rely on experiences that are salient to them to assess probability. So people have looked at, if CEOs experience a hurricane where their businesses, they overestimate the possibility of future hurricanes, right? So we've all lived through once in a century pandemic, and so currently the pandemic risk is salient in all of our minds, right? So even though the actual probability of the event might not have changed, our perception of that risk has increased because it's salient to us. Right? And so if risk becomes salient, we say that the perception of risk increases, and our measure of salience is going to be defaults on existing SBA loans. Right? So if defaults in a particular industry spike, risk salience in that industry is going to be more salient. Risk in that industry is going to be more salient. Well, default risk is increased. Maybe the SBA doesn't want, higher defaults, etc. Maybe there are budget constraints, reputational concerns, etc. So it cuts lending to that industry. All right. That's sort of one hypothesis. Another hypothesis, which sort of makes this an interesting empirical question is, well, none of this really matters, right? This is a bureaucracy which just implements the rules as given. They shouldn't really care about the risk salience, etc. Okay, so that's sort of the alternate. So we're going to do this analysis, we're going to merge two data sets. Well, the first data set is about loan level data, which is publicly available from the SBA on the 7A program, right? It's at the borrower. You have information on the borrower, lender, when the loan was made, what was the performance of the loan, did it default, or etc. We sort of aggregate this up to the office industry level. So you have one of those sort of 80 offices, and then we have a 3-digit NAICS code industry classification. So an example of a 3-digit NAICS code is restaurants and bars, because that's NAICS code 722. 72 is hotels, restaurants, and bars. Okay, so we're doing this at the restaurants and bars level. And so that's sort of the loan level data. The workforce data comes through FOIA requests. So we've, from the Freedom of Information Act, we've got information on the entire sort of HR workforce of the SBA. So this tells us the names, salaries, tenure of the people involved. Most importantly for us, the location of these employees, right? So we match this to the loan level data based on the office's location. And we define risk salience based on the SBA loan defaults in a particular industry. So again, think about restaurants and bars. Defaults in restaurants and bars in the Boston office is maybe a measure of risk salience. All right, existing loans in that office. And that is basically an average of an employee level measure. Okay? So I'll talk about this in a second, but sort of the major challenge here is that local industry conditions will drive both of these things, right? Defaults in restaurants and bars in Boston will also mean that the restaurants and bars are doing badly in Boston, so you would expect, to not make more loans to restaurants and bars in Boston. So we're going to use an empirical approach which sort of leverages our data. So let me just sort of visually illustrate this. All right, so you have 3 offices here: Chicago, Dallas, and Boston. And you have the SBA employees in these offices. And suppose an employee transfers from the Chicago to Boston office. All right, so they move from Chicago to Boston. And suppose defaults on bars and restaurants increases in Chicago. How does that affect lending in Boston? And does that actually affect lending in Boston? We find that it does. And it's through this channel, is that the employee there's an employee in Boston who previously worked in Chicago, because our empirical strategy looks at if there are increases in defaults in Dallas, that does not affect lending in Boston, right? So it's not that there's a nationwide shock or a regional shock or any of those things that's driving this. We're sort of isolating the effect of these employees moving across offices. And that, I think, helps us isolate the effect of their experiences. All right, so this is sort of the main results. In the interest of time, I'll sort of skip the specification, but sort of the, So this is sort of the main idea, which is that the share of restaurants and bars in Boston decreases if there are more defaults on restaurants and bars in Chicago if a person in Boston previously worked in the Chicago office. And we find it's a fairly reasonable effect. Sort of the share of that industry in the overall portfolio declines by about 10 to 11%. Right. And this effect is larger in smaller offices. It has real effects, right? So there's a decline in jobs which are being created with SBA loans. Interestingly, there's a decline in the creation of new firms with 1 to 4 employees, but not in firms with like above 100 employees. So it's like the smallest firms, which maybe are not able to get loans, credit anywhere else, are the ones that are most effective. The new loans, because of this, the portfolio does become safer, right? The loans which are originated when risk is more salient tend to default less, right? But is that, Jeff talked about sort of the mitigation of risk, not the elimination of risk. The question is that, worth it, right? The decrease in default. We sort of don't try to really quantify that sort of fully in this paper. Let me, in my last 2 minutes, sort of talk about the question of how risk perception affects SBA lending. So the local offices do not issue loans, right? But they have indirect influence on bank decisions. So we look at 3 things. So first, local offices affect lender participation because they are responsible for training lenders in the SBA program, reviewing lender performance, et cetera. And we find that if risk salience is higher, it discourages lender participation. The number of new lenders is lower. The concentration of lenders in the SBA program is higher. The local offices also affect demand by small businesses, right? Because they do all of these outreach education activities. They have programs where people who are not aware of the SBA programs are sort of educated about them. And so this could discourage borrowing. If they don't go out and approach restaurants and bars anymore, restaurants and bars won't come to apply to the private lenders, et cetera. And so we see that in the industries where there's risk salience is higher, number of new borrowers is lower, there's increased market concentration among existing borrowers. They go back to the borrowers they know, the repeat borrower action is higher. Finally, there's sort of a nice experiment here. Screening used to be done at the office level, the approval of SBA applications. but that was centralized between 2003 and 7. So we look before and after because our data spans that entire period. And we actually find that there is a significant drop in the magnitude of this effect after 2007. It doesn't fully go away, but the magnitude decreases by about half, which sort of points to pre-centralization. Screening had a role. It kind of suggested that centralizing the screening was kind of useful in a way here. All right, so since I'm out of time, let me just conclude. When defaults become more salient, SBA lending is lower. We talked only about the SBA in this paper, but I think sort of the takeaways could be broader in terms of how regulators, personal biases and experiences affect economic outcomes. So thank you.
Great, thank you.